All right, welcome everybody to episode 9 of the Wide Lens podcast. I've got my good colleague here, Matt Rigby.
I'm back.
And we're going to cover the latest topics in financial and investment markets. We are recording this on the afternoon of the 24th, Thursday the 24th of March. We're going to get straight into Matt's Market Minute.
All right. Okay, so Aussie market over the last week, so the 300 up just under 2%, down only 2.8 year to date. It's really coming back. Last 5 days, few random stocks here. PointsBet up about 1%. EML, which is a tech payments company, up about 10.8. And Square, or Block as it's now known, up 6.3. Year to date, the banks, CBA up 4.2, NAB up about 8, Westpac up about 10, ANZ down, Macquarie down 6. ANZ's down 1, Macquarie's down 6. That surprised me.
Why is Westpac and NAB up and CBA and ANZ's down?
No, ANZ and Macquarie are down.
Westpac's up.
Westpac, NAB and CBA are all up.
Why are they up and the other?
I don't know.
Westpac?
ANZ, I don't know. Maybe they're garbage. Macquarie surprised me. I thought they'd be doing quite well, given everything that's going on. The NASDAQ 100, just to make that clear, 100, up 3.5% week to date, down 11% year to date, so come back a bit. Over the last 5 days, Mercado Libre, the South American Internet of Everything company, up 27%. C, which is the Southeast Asian equivalent, up about 16%. JD, the Chinese equivalent, up about 40%. And Yandex, which I'm sure you're familiar with, it's the Russian equivalent, suspended from trade, but down about 69% for the year.
Down 69%.
Having a bit of a rough time. 8 stocks down over the last 5 days. Everything else is up, so it's been good. Year to date, NASDAQ 100, 49 stocks are down more than 10%. That was 72 last week, so a big improvement. And 21 in positive territory for the year. That was 15 last week. S&P 500 up about 2.25% for the week, down about 6.5% for the year. Berkshire Hathaway up about 5%, made an acquisition, which we'll mention. Their A share, just out of interest, trading at $521,781.
How many shares do you hold?
US, not enough. Nike up about 11.5%, and Moderna making a comeback, up 26% for the week. Year to date, 175 positive, that's 35%. 179 negative, that's 36%. Sorry, 179 down more than 10%. Chipotle's down about 10, Starbucks down about 25. They've got some union votes going on. And the CEO left as well, so that probably plays part of it. McDonald's down about 11, Yum Brands down about 14.5. Emerging markets flat for the week, down about 10% for the year. Oil making a comeback after our comments last week, up about 11%. Over the last 5 days, up 52% for the year at 114 US a barrel. And Bitcoin up about 2.8, so I'm going to call that flat given its normal behavior. That's for since Monday, and down about 11% for the year, sitting at about 42.5.
It seems like crypto, especially like Ethereum and Bitcoin, they're like moving quite a bit now in tandem with risky assets. Like I think that concept of it being a hedge, I'm not sure how true or relevant that is anymore. It just feels risky now.
Yeah, that myth has exploded. But yeah, it'll be interesting. We looked earlier in the year about that correlation, so I wonder if that's strengthened, something to look at.
Yeah, maybe something to put on the agenda, on the doc for the coming weeks. But the first article that I wanted to talk about, this actually came up late last week from Bloomberg, and I'll just get this headline up. Early signs point to downturn in Sydney property prices after a 27% rise. High prices, more supply, and prospect of rate hikes hit demand. And Sydney is the least affordable property market after Hong Kong. I don't know who's going to take over Hong Kong as being the least affordable, so it's definitely not going to be Sydney. I'm just going to bring this chart up, and so we've got the black 2020, 2021, you can see the not much movement during 2020. See the 27% rise in Sydney year on year. And then we've got forecast to be pretty flat this year, but then a decline of 23%. A couple of things I just want to point out of this article. CoreLogic estimates the number of properties on the market has climbed by 5% as sellers try to cash in before the boom ends, further weighing on prices. Quote, I just got a call from an agent regarding a house which is really struggling at his price guide. He's suggesting to me that we could buy it cheaper than they thought at the commencement of the campaign, so-and-so said. There's quite a few examples of that stuff going on. And finally, what Bloomberg economists are saying is rising interest rates and the prospect of tighter macroprudential policy are major headwinds for Sydney's property market, given rapid increases have resulted in house prices testing affordability limits. So there's a few things going on here. There's interest rates going up. There's just the pure sheer fact that it was up 27% last year. Like, I think that probably plays a bigger factor than maybe some of the others that it just ran really hard.
Yep.
And the concept about CoreLogic talking about there's more properties on the market and they've climbed 5%. Well, I think that's coming, we've looked at this a few weeks ago. I think it's coming from a really low base. So I'm okay with that. People selling property at less or, than what they thought at the original campaign. Yeah, of course, because people's minds are anchored to, well, it's growing at this pace.
Yep.
And I just don't think it can keep growing at that pace.
Yeah.
And what if we do fall by 8 or 9%? Does that align with the recessions that we're going to talk about later on? What do you think about all of this?
Yeah, it's interesting. And I think we spoke about a few weeks ago, maybe even a month ago, that we were seeing the highest auction volumes on record, I think for February, it's the end of Feb. But we've also spoken about, people's expectations were higher than probably what was realistic anyway, given that expected growth, and everyone expects property to keep growing at 20% a year. Clearly, that's not going to happen. So, I don't know. I mean, they're falling relative to extremely high expectations, but a price is actually falling.
So let's say you've got $1 million property. It's gone up 27% in the year, so you're up to 1.27 million. Mm-hmm. Then nothing happens, and then prices fall by less than 10%. So prices fall by 120.
So where are you at? 1.15. So you're up 15% over 2 years.
That's
pretty good.
I don't really get the big drama about all of this, and I could be completely missing something here, and I probably am, but I just can't make sense of all the. I don't know what the word is I'm looking for.
Hysteria.
Is
it similar to what we saw with interest rates? Everyone's coming out trying to go, all right, it's going to be 5, 6, 7, 8, 100 bloody increases this year. Property prices, they're going to fall. They can't keep going up. I mean, you look at that at 27%. Was that the early sign that property prices are going to decline, that it went up 27%? I mean, it's a phenomenal rise. Again, we looked previously about the average price rises over time. It's far and away one of the biggest year-on-year changes. So,
do you feel like it's a bit the supply issues that are going on? So, we talk about chips and inventory and whatever, oil. We can't get oil out of certain places. Is there an aspect or an element of supply shortages in property which starts to push prices up because people can't? There's just not enough supply and stock on the market.
Maybe, and think about all the flood-damaged houses in Brisbane and Sydney and New South Wales. I mean, that takes a whole bunch of stock out of the market. So people have either got to rebuild where there's already timber shortages.
People were moving up there anyway, originally, during COVID, right?
So maybe, ironically, maybe the flooding ends up putting a bit of a floor under prices because people don't want to wait and build. They're just going to go and buy with their insurance payout. I don't know what's likely to happen, but a slight decline is certainly not unexpected.
And what's prices fall 8%? I just don't see what the hysteria is about all this. Interestingly, though, Melbourne hasn't grown as much as Sydney has. Melbourne's been a bit lagging behind.
Locked down, you might say.
Nice. So look, this is not surprising that we have prices declining. I mean, it could be possible also that prices just don't do anything and everything else starts to catch up to make all these ratios.
And I'd love to see the split between apartments and established homes. That's going to be different, and maybe it's apartments that are pulling other things down, more than established single homes. So
Time will tell. Hey, happy anniversary for yesterday was 2 years.
Oh, thanks, Rob.
Can't
believe you remembered.
I remembered. 23rd of March, if we all remember, 2020 was the bottom of the stock market.
Man,
and not to brag or anything, but I remember we were publishing a lot of charts at the time saying, I think we hit a bull market. I think we hit a bull market. Markets were up like 15, 16, 17, 20%. And no one believed. No one believed what was going on, right?
Yeah.
And then here we are, 2 years down the track, 24th of March, 2022. The S&P 500, as of close yesterday, price only, is up 99.17%. It was up 115% at the beginning of the year. But mate, I'll take 99%.
It's pretty good.
50%
a year, right? For 2 years. That's fuck, man.
Pretty good,
crazy.
right?
But they were crazy times. I mean, you're right. No one wanted to buy. Everyone was just trying to cash in. Is it too late to sell? Yes, it was. But yeah, people were freaking out. Man, it was just horrendous.
The short, sharp nature of the decline, and also the short duration of the decline, and then bang, you're up pretty quickly. And it is hard to see some of these things.
Yeah.
It's very hard to see these things. Yep. And I remember talking to a lot of people, dead cat bounce. This is not really come back down again.
That was the fear, wasn't it? It was just the relentless nature of day after day of large falls. And then I remember oil joined the party and went negative, and it was just
insane.
Like all hell was about to break loose.
It was fascinating. I found it fascinating.
It really was. And speaking of declines, although not quite as cheery, so this one, this is a table from Jim Reed at Deutsche Bank, and we'll bring this up now. The playbook worked nearly perfectly. So if you recall, I don't know, a month ago, I think.
It was a few weeks ago we shared the
Deutsche Bank published this table of historical geopolitical events and sort of the duration and how long it took to get from, the number of trading days of the sell-off, and then how long it took to get back to recovery. Anyway, so post the decline, and I guess they're calling the bottom of this decline, post the Russian invasion of Ukraine.
So what are they? It's that last line item.
The last line.
So what? Yep.
Yeah.
Gotcha.
What they're basically saying is, from the event date and the start of the sell-off, there was a duration of 17 trading days of the sell-off to the bottom, and then the duration of the recovery was 11 trading days. So that compares pretty much in line with the historical average. So the average there of 17 versus 15, and recovery 11 versus 16. So not too dissimilar. As we're only fairly early into this, shall we say, the recovery over the first week from the bottom was 0.7 of 1%.
So you're saying is it the bottom?
Is it actually the bottom? Is this dead cat bounce? And historically, medium 3.3, average 3.1. So I guess we'll know over time. But looking at that previous chart, we have had quite the bounce, although that's not necessarily related, in terms of the start of the Russian invasion of Ukraine. But in terms of that bounce there, and it certainly played part of it.
So are we?
Yeah, we've had a good bounce.
Have we hit a bottom? What do you reckon? Don't sit on the fence.
I so want to say yes. Maybe. I mean, just think about start of the year, inflation and interest rates, what's going to happen? That was the big question. A lot of that uncertainty is now not being removed, but it's starting to be, revealed.
It was priced in, right? Like the market responded super quick.
Yeah, and the market
always does.
Expects worse, right? Because they don't know. So uncertainty, you anticipate worse. It hasn't quite been as bad yet. It might be. Russia, Ukraine, I mean, it looks like this thing is going to drag out for a hell of a lot longer than what anyone thought. Putin, he's got to be pretty pissed, you would think, that this hasn't happened as quickly as he thought it would have, and his army really haven't kind of done as much or made as quick ground as what he was hoping. So, my gut feel is that we probably have. We'll get onto the Fed and interest rates in a little bit, but I still wonder whether there's a bit of maybe we're underestimating the number of interest rates. I don't know. I don't know. I'm going to say yes, we've hit the bottom just because I'm not allowed to sit on the fence.
Well, I'll take the other side of that. I think all the stats are showing that we're going to hit a recession, and we maybe...
When?
Well, hold on.
Okay.
We won't know until 6 months down the track, towards
the
back end of the year.
Yep.
But one could be unfolding right now.
Are you saying Q1 this year we're in recession? This is our first quarter of negative growth?
No, not Q1. Maybe Q2, Q3 we'll start to see.
Oh, okay.
Start to see that, and I'll explain in a moment why. But maybe to wrap up on the Deutsche Bank Jim Reed chart there, I found that interesting. So the average days for a sell-off was 15. We hit 17 for this.
Yeah.
The median duration to recover was 16 days. We did it in 11. The average sell-off has been 7.5% from the bottom to 1 week later. The size of the sell-off was 7.5%.
Pre-event to the bottom.
Sure.
Yep.
And the Russia-Ukraine was 7.2%.
Yeah. That's a good point. I jumped that, but you're right. I mean, it's almost... As they said, playbook, almost textbook.
Almost to the textbook. I think that's really interesting. No one knows what's going to happen from here, but I think some of the other areas we'll cover might shed some light on that. So I want to jump to the next one. There's a lot of talk about interest rates. Powell's come out and was, with 25 and then just quietly sneaking in, I reckon we'll do 50 next time round.
Yeah.
And that's cool. We continue to go from free money to cheap money, and I don't think the Fed is even the Fed's not even neutral. Like, it's still so far accommodating that maybe 50. I mean, what does 25 even do to people's lives? I just don't think anything.
Nothing.
And so maybe 50 is the right number. I don't know, but the market is pricing in like 6 or 7 hikes from April or May, or from May onward, which will see us right through the end of the year with a hike at every meeting. But what's going on with interest rates at the moment now? And I'll share this chart in a second. But what is going on is that the short-term interest rates in the market now are much higher than long-term interest rates. So we have what's called an inverse sloped yield curve.
Yeah, which I think we mentioned last week, how that happens.
And so the expectation is that longer term, people see problems and people see interest rates lower further out. Normally what happens is when you go and lend money out, the longer you lock up your money, there is an expectation that you are compensated for locking up your money for a longer period of time. But what's happening now, it's the opposite. So the short term is higher than the long term. And I want to bring this chart up, and I've titled it the Recession Oracle, which is the 10-year minus the 2-year US Treasury rates. And so I put this chart up from 1985. Every time this thing has... Do you remember that octopus, that World Cup octopus that used to like predict the winners and then it died?
Oh, yeah.
Do you remember that?
Yeah.
This is
Football World Cup.
Yeah. What did I say?
Yeah. No, you said World Cup. I just wasn't sure which one.
Yeah, soccer, football. You call it football, I call it soccer. But this is like the octopus oracle of recessions. And so when the 10-year minus the 2-year rates go negative, so have a look at the late 80s, then we had late 80s, the interest rates hit below zero and in fact go negative. We have a recession in 1990. The same thing happens again in 2000. The same thing happens again during 2008, 2009. The same thing happens again during 2020. Look where we are on the far right-hand side. Depending on how you put this chart up, I've seen some charts doing the rounds that have shown that number actually hitting zero now. But in their version of the chart versus ours, it didn't hit zero in 2020. So anyway, that's all details. But the point is, this thing has a 100% track record of predicting a recession soon after. And so, if something's got a 100% track record, I'm probably going to believe it. If rates continue to do what they're doing and this thing inverts, then sure, we're going to have a recession.
Doesn't look good, does it? And so Powell, earlier this week, I think it was speaking at the National Association for Business Economists in Washington, and was being asked about interest rates, and he basically said, look, 50% at the upcoming meeting or meetings.
50%?
Sorry. Fuck. 50 basis points at the upcoming meeting or meetings. So he went out of his way to say more than one meeting. 50 basis point rises aren't out of the question. He said, if we conclude it's appropriate for them to move more aggressively by raising the federal funds rate by more than 25 at a meeting or meetings, we will do so.
Sure.
When asked, is 50 out of the question? He said no. The bond market, so the 5 and 10, which doesn't have a predictive history, but it's a bit of a kind of leader into the 2-10. So the 5-10 actually went inverted, negative at that point. So,
but the 5-10's not the 10, or the 10-5 is not the oracle.
No, it's not. It's the 2-10. But when asked about inverted yield curves, Powell said recessions chronologically followed by the conclusion of a tightening cycle. Sorry, they are followed by a conclusion of a tightening cycle, but recessions were not apparently due to excessive tightening of monetary policy. So basically what he's saying is, yeah, it happens, but it's not because interest rates have gone up, not because we've tightened monetary policy tight. I don't know how you decouple that. To me,
we've looked at charts that have shown recessions following the peak of tightening cycles every time.
Yeah, and I mean, it makes sense that tightening cycles peak when you get into a recession, because what do? They cut interest rates. So I guess what he's trying to say is the yield curves aren't inverting because we're tightening, the recessions aren't happening because we're tightening, and yield curves are inverting because we're tightening. I don't know. Yeah, I was a bit confused by his comment. I couldn't quite work out how he distinguished the two. To me, they're so interlinked that tightening cycle, inversion of the yield curve, recession, they seem to happen in a fairly consistent pattern.
Well, what needs to happen? The 10-year just needs to go up and make it all better again. I mean, what can the Fed do? Can the Fed just buy? Can the Fed buy up 2-year and sell 10-year treasuries? Like,
I guess if they're raising rates and buying the 10-year, pushes them both up at the same time. But their job isn't to stop the yield curve inverting. just to make the chart a liar.
Look, based on this, I think this is really interesting. The odds are in favour of a recession. But maybe if we're talking about it for long enough and it actually happens, people are like, oh, that's done, let's move on to the next thing.
Maybe. And just on that, James Garish from Market Matters put up this chart Monday or Tuesday, I think it was. The number of, so just quickly to talk through this, so that you can see the sort of steepening curve here. As time goes by, and this is Australia, the market is expecting more and more hikes. So March, 1 hike, Feb, April to May, so on and so forth. So by the end of the year, the market's expecting 6 interest rate hikes here in Australia.
Wow. By the end of this year?
With a 1.6% policy rate by the end of this year. I find that really difficult to believe, but we might be wrong.
We're not the experts.
Yeah, but anyway, we'll watch that one, that's for sure. All right, so moving on to the next one. Inventories are rising, and well, maybe this is an early indicator. So retail inventories are rising. We'll bring up this chart from Refinitiv and, of course, us, where it's just tracking the inventory sitting in shop shelves or on the shelves within shops. Now, I saw this and was kind of blown away by the steepness of that move from the COVID lows in 2020 out to where we are now. So this first chart's going back to 2015. So you can see that aqua line, that's the trend line, so significantly above trend. So when we move the graph out a little bit,
because you were like, what's it like from 2000?
I was like, there's no way that is an outlier, but it is. It's an extreme outlier. So even back to 2000, I mean, look at that build up going into that GFC recession. And the 2002 recession, I mean, that inventory starts to build up. There's also a bit of a pattern here. Inventory starts to build up. Maybe retail spending is so high, retailers are bringing in lots of stock. It, artificially maybe creates a bit of a supply driver within the economy. We go overheated.
I didn't notice that, actually. That's a really good point.
But yeah, we're kind of flying off the shelves, they're stuck on the shelves at the moment. One thought I did have is, given the supply issues that we've had, have they ordered a ton of stuff? It's taken so long to get in that it's all arriving at one time, and now they've just got tons of stock sitting on shelves, which just leads to sales downgrading retail earnings, so on and so forth. So.
But retail sales are coming in still pretty strong. I don't know what this is. Is it time that it's taking to get out? Like I just don't know why it's so high now, because it's been rising since the bottom of COVID during 2020 through 2021. It's been on the rise.
And maybe that's expected with those supply shortages. We have a massive shortfall here and a big rise, but the chart's getting steeper, or that rise is getting steeper. So.
Yeah, and if we start having interest rate hikes and people having less money, running out of stimulus money, etc., people aren't buying stuff.
No, exactly
and
right.
If fuel is costing $2.20 or $2.30 for diesel, people aren't buying stuff.
And food's going up, so this could be.
So I think this one will be good to watch.
Yep.
So I want to talk about this now. I think you and I are going to maybe have some differing points of view, although I don't think too much. You're a smart guy. You look at facts and figures and evidence. SPIVA, so the Standard & Poor's Index versus Active results came out for 2020.
This is one of your favourite topics. You love this shit.
Who's got 45 minutes to talk about SPIVA results? So, look, what the SPIVA report basically does is it looks at what they call passive funds, so maybe index, exchange traded funds, etc., versus or benchmarks versus those investments that are trying to pick stocks and who are more active, who have a more active approach, and compare how successful are the active stock pickers versus that of if you simply just held the broad market index. Mm-hmm. So, Warren Buffett comes out with his quote and says, in my will, I've left my, estate to my wife, and I've advised her to invest in a 90-10 portfolio, bonds and S&P 500. Yep. And that's the best way to approach investing. And so the first chart that I want to bring up here is, this is US data. The percentage of all domestic equity funds underperforming the S&P Composite 1500 on an absolute basis. So they run it on absolute and adjusted for risk. This is on absolute. Have a look at this. In 2009, 40% of funds were underperforming the S&P 500.
Yep.
And then we go on. It's ranked by how much they're underperforming. Now have a look at 2021, the year that was for active management. Close to 80% of all US domestic equity funds were underperforming the S&P.
Not great, is it?
Now, things don't look like they're getting better here. I don't know where 2022 is going to sit, but it's probably fair to say that a lot of those funds that went into the FOMO camp and bought up growth stocks, and when you had a shift from growth to value, it's almost like you just got up and then someone's just smacked you in the face again.
Yeah, absolutely.
So what are your observations here? Like this is fact, right? This is not, no one's made this up. Like this is fact. Actually, before I ask for your observations and comments, I just want to move on to the next one. I'll bring this second chart. Again, this is US data. I'll talk about Australian data in a second. Percentage of all domestic equity funds underperforming the S&P 500 on an absolute and risk-adjusted basis. 3-year, 5-year, 10-year, 20-year rolling periods. Over 3 years, 72 and 80% measured in absolute and risk-adjusted. Over 5 years, 75, 81. But look what happens when you go further out. Look at 10-year and 20 years. You've got like 10% of funds outperforming. Now, I don't think that even takes into account survivorship, which I'll talk about in a second.
Well, it must, right? Because how would you be able to... Oh, you mean stripping them out all the way back? Yeah.
I believe it's only of those that have survived.
Okay. So they may have survived 10 years, not 20, but they're still in the 3 and the 5.
Correct.
Yeah, okay. Look, it's...
Can we talk about Australia before you share your point of view on this? So the next one is Australia. So I just want to bring it close to home. The S&P have categorised it from the fund category up top. So that is based on absolute. The table at the bottom is risk adjusted. We've got large cap, Australian equity, mid-small, international, Australian international funds, Australian bonds and Australian equity A-REITs. And then you can look at it on a risk-adjusted basis. Like they both tell a very similar story. So I'm just going to focus on the top one because it's just at the top. Look at the 1 year. Percentage of funds outperformed by the index. General equity, 42 were outperformed.
So 58 outperformed the index.
Correct.
Yep.
That's right. So actives winning. But once you start, and so this is the thing, right? On a 1 year basis, how do you distinguish luck versus skill? That's the question. You then go out 3 years. You go out 5 years, 10 years, 15 years. And so you're sitting at 15 to 17% of funds that are outperforming the index. Yep. The question is, how do you then pick which fund is going to outperform the index for that time frame? Because remember, in 1 year, it's only 42% of the funds outperforming the index.
Yeah. How do you pick that next year?
Yeah, that's right. And then the other thing I just wanted to bring up, actually, I've got it here. Let me have a quick look to see if I've got my survivorship numbers here. Here we go. All right, I'm just going to get this number up. So I'll just put this in here. I just realised it wasn't in the deck.
But getting back to, I guess, those hardcore, those numbers.
Here we go.
Really
it's in the
interesting.
deck.
All right.
Let me just finish off on this. Survivorship of funds. So for 1 year, Australian equity funds, 322 funds at the start, 91% survived. Pretty good. That's 1 year. And then have a look at 5 year. The number drops to 70%. And I haven't put all the numbers in there, but I will tell you the numbers. All categories, Matthew, over 15 years. Guess what the survivorship is.
Based on that trend, I'm going to say like 60, 50% survive?
46%.
Oh, really? Wow.
And so there's this challenge of funds not even surviving for a variety of reasons. And I bet you the number one reason is we just had shit performance constantly. And so we shut the fund up, we phoenix and we're reborn under a new name, new colours, maybe a new ESG fund, and let's go raise some capital again.
Start all over again.
This is really hard because as human beings, I think we're wired to believe that we are better than the average, that we can do better than you and our next door neighbour and so forth. But the reality is that we have thousands of people all around the world, if not millions of people all around the world, institutional investors. We have large organizations that do this for a freaking job, man. Like their job is to try and work out whether NAB is going to be doing better than Fortescue Metals. Like that's their job. And the reality is they don't get it right. So I just wonder, how do the likes of financial advisors or anyone sitting there on a computer with like a NAB trade account thinks they're going to outsmart or outbeat any of these larger hedge funds, institutional funds, like
who can't do it.
For me, it just seems like a bloody hard task. What do you reckon about this?
Yeah, it is difficult, and I think the more transparent the market, the more difficult it is.
Totally.
So, like you think about.
I know what you mean, but elaborate, please.
Yeah, you think about let's think about the Aussie market. So it's made up of 5 banks, a telco, for 3 mining companies, a couple of supermarkets, whatever, and property development company or 2. They are so well understood. They are so well covered by the analyst community. I mean, every Joe Blow on the street knows something reasonably insightful about almost all of those companies. Throw CSL in there as well. So I think all information is known pretty much at every point in time about each of those companies. And you could probably extend that out to the top 20. The reason I say the top 10 is because the top 5 make up such a large portion of the Aussie market that concentration it makes it really, really difficult.
So the question is, what is your edge? Like what is someone's edge covering Wesfarmers or covering BHP? What is their edge that they know something that no one else does?
I don't know that they have an edge on knowing something that nobody else does. I think where you might have an edge is if you're able to not react with the rest of the market. And my point here...
What do you mean by that?
Well, I guess what I'm thinking about is think back, I don't know, 2 or 3 years ago when all the banks just got... So the COVID, 2020, the banks got absolutely hammered and it took forever for them to recover from their highs. Recover from the low to capture the pre-COVID highs. If you had have asked anyone in a rational state of mind, will the banks recover and will they be okay in the long term? You would have said, yep. You go, well, why aren't you buying NAB at $14 and they were at $25 not long ago? They were issuing capital. I think NAB, not all the banks, a couple of them were issuing capital at absurdly low prices. So if you've got the time and the patience to get in at that point, I think that maybe that's your edge. What's working against you is everyone is expecting you to outperform every single year. And so I think that skews active managers' views in the most part. And speak to any value manager. I mean, they've had a shit of a time over the last couple of 15 years probably. And they've been pounding the table going, this is not sustainable, value stocks, I don't know if I've answered the question, but I think it's insanely difficult, especially in those bigger markets. When you get down to the smaller caps, micro caps, it's not as well covered, those companies, and therefore I firmly believe fund managers can get an edge because they can go and sit in front of Joe Blow, the CEO of some small company, and they'll get a real story because no one's going to see them. So
yeah, but what's a CEO going to do? He's not going to give him a shit story. He's going to pump up the tires to some extent.
Maybe, but you go and sit in front of the CEO of CBA, and he does this all the time. So he's pretty polished. You go and sit in front of the CEO of, I don't know, not you, but some other small financial planning company that's maybe listed, and they're not going to be as polished. And so maybe you can get some edges there. I don't know. But in well-covered markets, I don't think.
What information can they relay to someone that's not public? Like, what do you do? You get like we've talked about this.
Hey, do you think it doesn't
body
happen?
language?
100% it happens.
That's illegal, man. That's insider trading.
It is illegal, but I firmly believe 100%. If you've got a fund coming in and they've got, I don't know, $5 billion and they're going, we really like your company, what can you tell us? They'd be like, all right, here's what we're going on.
I don't know.
You don't reckon? I really don't.
I didn't say I don't reckon. I just said I don't know.
Because ultimately CEOs are often compensated based on share price performance. That's one of their part of their performance bonus. So they're incentivized to see that share price go up, as it is for all shareholders. But I wouldn't be surprised. But anyway, getting back to the point. Fixed income market, I've always firmly believed it's really difficult to outperform in an active state. Property market in Australia, the A-REITs, it's small. Everyone knows them. Doesn't surprise me at all. What I'd love to see is Australian-based managers managing international money versus US-based. So Australian-based managers, managing international versus US-based managers managing international. And the reason I say US is 60-odd%, 70% of all international portfolio allocations is US based. I wonder if not being
over what time frame? I'll tell you the numbers now. What time frame do you want to know?
Say 15 years. Are Australian managers or non-US managers better outperforming in global markets than US based managers?
Can we just use 10 because I don't have a 15?
Go with 10.
So absolute or risk adjusted?
Go absolute.
So absolute, 86% US equity managers managing domestic equity.
Yep.
86% have underperformed.
Okay.
The index.
Yep.
And what was the other one?
Australian-based managers managing international portfolios.
International equity, Australia, absolute, did you say?
Yeah.
92% underperform.
Oh, really? Okay.
So you got 86% of US managers underperforming US equities. In Australia, managing global, not just US,
but global.
92.
Sure.
So the numbers are 86%, 92%.
So I always wondered whether not being there gave you an edge to not be distracted by the noise, but clearly not. But they're not like for like. But it
Like,
would
I don't know
appear
this.
not.
Yeah.
Anyway, really interesting. Look, I think I've always had a bit of more of an active skew, but I think having at a very minimum a big large chunk of index. I mean, at the end of the day, you're going to perform the index, right? So you're not going to out under, but you're just going to get those market returns over time, which are, over 100 years, are really, really good, and they're good enough.
JP Morgan did a ton of research on this, and I mentioned the Delbar a few weeks ago. JP Morgan have got data that shows what average return certain asset classes have returned, and as well as the average investor. So many people are focused and so keen to try and beat the benchmark. Like there's this affinity to beat the benchmark. Yet meanwhile, people just don't look at it slightly differently and think, well, how can I make sure the benchmark doesn't beat me? Instead of me trying to focus so hard on beating it, you're blindsided by a whole bunch of things that happen. Yet focus your time on trying to not be beaten by the index. I don't have this in the doc, but this is only like 2 weeks ago, actually. Vanguard is grabbing flows in $6.8 trillion ETF world. Vanguard is coming to surpass BlackRock's at US assets. They're holding close to 30% market share. Of the record $900 billion that poured into US equity ETFs in 2021, roughly 1 in $3 went to Vanguard's most passive, dirt cheap products.
Yeah, their product over there is like 0.06 or 0.02.
Not even worth looking at.
It's close to zero. It's absurd.
But I think investors are becoming more versed and knowledgeable, and are now seeing how hard it is.
Yeah.
And this concept of this year is the year for active management. Like, how often do you hear that?
Well, it depends.
And I've got the numbers are here, man. Like,
you speak to Vanguard, Noah. You speak to active always, every year, right? But there are managers who have consistently outperformed, and not every single year. And I think maybe that's part of it also, over long periods of time. But they're few and far between.
All right, look, let's jump straight to director's cuts. What do you got for us today?
Yeah, so this first one was just something interesting that I came across about Tesla. So innovation over advertising. So this.
Oh, I think I've seen this.
Yeah, so we'll bring this up now. This is just comparing the ad spend per car sold. That's the red bar. And R&D spend per car sold for each of the majors. So Tesla, Ford, Toyota, GM, Chrysler. I knew Tesla didn't spend any money on advertising. I've always been fascinated by the fact that they don't. I think Elon Musk probably gets enough airtime. We don't need to put him on ads.
That's the advertising on Twitter.
But the R&D per car sold, the fact that they spent more didn't surprise me. The magnitude of their spend relative to others did surprise me. I mean, look at Ford, Toyota, GM. I mean, they're spending less than half of what Tesla spend every single car on average. And the advertising, it's probably interesting that Chrysler spends so much relative to the others, and yet I think they've got the smallest market share out of those other four. I don't know if they've got smaller or larger than Tesla, but certainly Ford, Toyota, and GM. So that was just interesting. Advertising, not everything. It would
I always thought advertising, well, I think they're advertising, but maybe in slightly different ways. The thing that I wanted to bring up, you mentioned Nike. Is it Nike or Nike? Nike, whatever. Their stock down about 10 or 12%. So they just reported quarterly earnings the other day. And so the company's gross profit margin increased to 46.6%, up 100 basis points from the prior quarter. And so what's happening is here, their gross profit margin is increasing, and its sales are rising faster than its costs, we can see. Mm-hmm. And the thing that I was really curious about was this concept of inflation and eating into margins. I want to bring this chart up. FactSet had this chart, which is the number of S&P 500 companies citing inflation on earnings calls. And look at Q4 2021, 356 sightings of inflation. Meanwhile, you've got companies making record margins, and so consumers continue to absorb the cost of price increases.
Yep.
The things that I'm really curious about is why do we have such high inventory levels that we just talked about before. At the same time, we've got people still buying products and services with price rises. So I found that fascinating. I don't know if it's a turning point or whatever the case may be, but inflation and high profit margins, it's mind-boggling.
Yeah. Just on Nike, the Chinese sales were down 24% in the previous quarter, and down 8% this last quarter. So still a lot, but making some headway. The last thing I wanted to talk about is the legend, the oracle, Mr. Warren Buffett, went shopping last week, which I think maybe we sort of alluded to he would be looking. And one thing before I get into it, one thing to note is towards the bottom of the GFC, Buffett went shopping and went shopping pretty hard. So maybe this is the low of the market.
Bottom of the market. We're talking about recession. Recession's coming.
Yeah, he's buying, so it's time to buy. If Buffett's buying, it's time to buy. Anyway, so went out and bought another insurance company. I think about 70% of their business is insurance and reinsurance. Interestingly, though, they've also got funeral businesses, manufacturing, engineering, toys, musical instruments. Spent about 11.6 billion. They do have about 150 billion in cash.
What was the premium on the share
24%. So they paid about 1.24 times book. Typically, Alleghany's traded about 1 times book. So they did pay a premium, which you always have to if you're going to take over a company. I mean, he could have bought 50% for no premium, but if you want it all, you got to pay. So they paid about a 25% premium. Interesting.
I did see that. How do you pronounce the company's name?
Alleghany.
Alleghany.
Something like that.
Quote
America.
Buffett. Berkshire will be the perfect permanent home for Alleghany, a company I've been watching closely for 60 years.
Patience.
Do you find that?
So he would have been like 30.
What? The guy's like not how old's Buffett?
96.
Oh,
So it
yeah.
would have been 36.
Yeah, you're a good financial advisor. Good math.
What'd you say? What do you think it was? 100?
I had no idea what I was even doing. But the thing that I find really interesting about that is people look at companies or stocks or whatever, and they'll see one thing and they'll be like, hit the buy button, and they're snapping up the company.
Yep.
This guy's sitting here watching a stock or a company for 60 years before the guy even goes and buys it.
Yeah.
He goes and buys the whole thing.
And I wonder why now. Like it's historically traded around 1 times book. So it's not like it's price is depressed or whatever right now. So I wonder what the timing was. Maybe he's seeing something, an opportunity that others aren't.
Do you remember when Warren Buffett was referred to as a washed up old man?
Yeah, several times. Yeah, remember the 2000 the dot-com boom? He was, he didn't understand it, so he didn't get in.
Do you ever watch Dave Portnoy?
No, I don't even know.
He's
what you
the
just
El Presidente of the Barstool Sports in the States.
No.
So if you watch when I first met this guy, I didn't even know if this guy was legit or not. But so he's got this. He's got a tweet of this video. He used to make videos during the pandemic, and people were just following. Like he would have a bag full of what's that game where you put letters and you make words?
Like Boggle or Scrabble.
Scrabble. So he had a bag for Scrabble letters, and he's pulling letters out, and he's like, "I'm going to buy a stock named E," and he'll go and buy a stock named E, and it'll go up because all these memes. And he was just, he was like the president.
That's so funny.
He's got this tweet. I just brought it up. He said, "I'm sure Warren Buffett." So when was this? June 9, 2020. I'm sure Warren Buffett is a great guy, but when it comes to stocks, he's washed up. I'm the captain now. Hilarious.
Many times I think he's been called washed up, and he's still doing it, still killing
Do you reckon it's his last hurrah?
I don't know. I wonder whether he'd love to just buy one big $50 billion, $80 billion elephant gun, bring it out, let fly, and then that's it. That's his signature.
All right, let's get into let's wrap up with tips and recommendations.
Tips and recommendations. All right, so I've got a prac, you might say, this time round. So I brought along a couple of beers.
A what?
Prac. You
What's
know,
a prac?
back in your theory and prac back at school, you'd have a theory lesson and a prac
Oh,
lesson.
prac, yeah,
This
gotcha.
is prac. So where are they? There they are. So we're taste testing beers.
No, but you need to clarify what type of beers we have.
So they are O'Brien Pale Ale, gluten-free beer. It is, in my opinion, the best gluten-free beer you can buy out there. O'Brien's, if you're listening, still waiting for that endorsement call. Been waiting for 9 episodes now.
So where's the brewery?
They are in
Wendouree. Where's that?
Ballarat.
All right.
They got a lake. Do you know that? Lake Wendouree?
Does it have
a stunning
let's try and see if we can.
moss reed filled lake.
Did you hear that?
I did.
That's right.
It's very
Is
nice.
gluten that does that? Clearly not.
It's the expectations getting out. Anyway, anyway, one of my favourite beers. Took me a while to find gluten-free beers. I know there's millions of us out there. So
Is there millions of you?
millions of
Right.
gluten-free beer drinkers
Yeah.
in Australia. It's a very niche market. But anyway, give it a whirl, man. I think you'll be impressed.
All right.
It's not alcohol-free like your last review back in episode 1, was that?
Shit, that's not bad. What does gluten do?
Ringing endorsement.
What does gluten do to a beer? Like,
I
why
have
is it in
no
there?
idea. Well, it's part of the hops process, right?
Ah, of course.
Yeah, but I don't know. I've often wondered, but don't really want to know what it is that they do
Sure.
differently. Like, what are they putting in that's not barley and
I don't know, man. I'm not
Whatever
a
else.
brewer. I just drink.
no? Anyway, O'Brien's, come on, we'll interview you. You can tell us, and then I'll sign that endorsement deal.
All right. So
Anyway, so give it a whirl. You get it at Dan Murphy's, and
it's not bad. We
That's
should
the only place I
we
know.
should reach out. Maybe get someone from O'Brien to come over as a special guest.
yeah,
For 10 minutes
they
and
can
tell
talk
us
to us
about
about the process.
the beer.
Yeah.
So while we're enjoying this, I watched, and it's like 6 episodes maybe. Netflix, Bad Vegan, Fame, Fraud, Fugitives.
What?
Have you not seen it?
No. What the hell is
So
this?
Bad Vegan is about this lady she was, I think, like ahead of her time. She had a raw vegan restaurant in New York City, and it was called, God, I can't remember what it was called. Anyway, celebrities would turn up. They would just walk, into the back of come out from the back into the kitchen, say hello, and it was just the place to be.
Right.
And it was absolutely pumping. This lady, she has investors on board and whatnot. Her relationship with her husband sours. She finds someone else that doesn't last, but then she finds someone online, and I think Netflix has kind of the algorithm on Netflix has worked me out.
It's got you sorted.
And so this guy, she's talking to this guy online for months and months and months. Anyway, they end up meeting. He tells her about who he is, what he does, etc. Cut a long story short, he basically starts asking her for money. This guy's loaded. He's got lots of money, but he's to prove her love to him, she must give him money. And so she's just bought out her investors. She's in debt. The business starts doing well. She's drawing money out, and the staff start noticing like this weird guy popping in and out of the restaurant. And eventually, the restaurant shuts down. Staff aren't getting paid, and the headline I think is like vegan caught eating Domino's pizza in some town in the US. So then this guy goes on the run. He's like an addicted gambler.
Right.
He's taken her and she's just like living in this fantasy of wanting to find true love. And you're sitting there watching, you're like, what's wrong with this woman? What is she doing? And everyone that observes her, like all of her staff who've known her for many, many years, are like, what's wrong with her? What's going on? And they were skeptical from the day.
Like they didn't know that he was milking her.
No,
But
but they knew something was wrong. Like this guy was not, something's wrong. They go to jail. She gets bail. He does not. He eventually
She goes to jail.
Yeah.
What for?
That's
interesting. I need to watch it.
Well, she didn't pay any of her staff. She didn't pay tax.
okay.
So I think
no,
the collateral damage was like $6 million.
Oh,
yeah,
shit.
pretty big, man.
Fuck.
And it was just really sad to see like what she had to what it became.
Yeah. Oh man.
It could have been done in like one episode, and so maybe you can want to watch it on 1.5 times. But Rotten Tomatoes have given it 100%.
Yeah, well, I'm just reading Google reviews, and the second review is, I watched this on the heels of Tinder Swindler, which I suggest all viewers do.
What was the other one we watched?
Rob B, I think the review was.
Inventing Anna recommendation from a client, which is
that's
all
right.
to do with fraud and scams.
There's a theme.
All right, the video's going to be up on YouTube next week, Tuesday night, and maybe while you're sleeping on Wednesday morning, the video will hit. It'll hit Spotify, Google, and what's the other one? Apple.
Just that little company.
And
They're
I
emerging
think
company.
Matthew, we are working on something with the production people on a little new surprise. So we'll see how that one goes, and
Bring
we'll
bring it on.
Let's see how that one goes. But
don't be afraid to drop us a line. info@baharianwealth.com.au.
and
like us. Do
we'll
whatever you need to do.
We'll chat next week.
Yes. What are we going to do next week? Another beer?
Do you have any other beers? Do you have any other gluten-free beers? This is pretty good, man.
There are a few out there. There's probably like 4
Is
that
this
I'm
like the
aware
best
of.
one?
This is the best one, I think.
Okay.
I think I've had each. Well, I don't know how many are out there. I've had 2 or 3. This to me is the best.
How much is a slab? Does it come in slabs, or do you only?
No, you can. I don't know, $60
For what? 6? Is 6 a slab?
6 beers or 6?
I don't know how many comes in a slab.
48.
Okay. All right, let's wrap up.
24. Maths is all wrong.
Gonna get
Anyway,
bored with this.
they're done. Then no one's listening.
We'll catch you next week. Thanks.
All right, guys. Cheers.